This is one of those moments when markets can teach people the wrong lesson if they only look at the price. The S&P 500 has recovered sharply, the Nasdaq has recovered sharply, Bitcoin has moved from the mid-$60,000 range toward the upper $70,000 range. Risk assets that looked weak only weeks ago are suddenly acting strong again. People who were frightened are starting to feel relief. People who stayed on the sidelines are starting to feel regret. People who bought the dip are starting to feel intelligent, and people who still see risk in the system are starting to wonder whether the market is ignoring reality. That is the dangerous part. A market rally does not always mean the problem is solved. Sometimes it means the market is taking comfort from the fact that the worst case scenario has not happened yet. That is very different. If you understand that distinction, you will think more clearly. If you do not understand it, you will either chase too late or sit frozen forever. Right now, the market is responding to several forces at once. The extension of the US and Iran ceasefire has reduced the fear of an immediate global shock. Corporate earnings have remained strong enough to support confidence. AI momentum has not slowed. Investors still believe that the biggest technology companies are building something transformational. Bitcoin has benefited from renewed risk appetite and the belief that the next cycle may still have substantial upside. On the surface, that looks like a clean bullish story, but underneath the surface, the risks have not disappeared. Oil prices are still elevated because supply risk around the Strait of Hormuz has not gone away. The ceasefire is not a permanent peace agreement. The conflict has not been fully resolved. Inflation is still vulnerable to another energy shock. The Federal Reserve is not yet in a position where it can simply cut rates without worrying about the consequences. And if oil stays high, it can quickly pull liquidity away from risk assets. So this is not an everything is fixed rally. It is a relief rally supported by earnings, AI optimism, and the absence of immediate disaster. Those are useful conditions. They are not the same as stability. That is the first principle. Price action can improve faster than reality. Markets are forward-looking. They do not wait for every risk to be resolved. If investors believe the probability of a worse outcome has fallen, they buy before the all-clear signal appears. If they believe earnings will remain strong, they buy before the economy feels safe. If they believe AI will keep attracting capital, they buy the companies tied to the theme even while macro risks remain unresolved. This is why markets often look irrational. They are not pricing the emotional condition of the average household today. They are pricing future cash flows, future liquidity, future risk appetite, and future expectations. They can move higher while the world still feels uncertain. But that does not mean they are always right. Markets can also become greedy. They can overreact to relief. They can treat a temporary truce like a permanent solution. They can price in rate cuts before inflation permits them. They can treat strong earnings as if they will never slow. They can treat AI optimism as if every dollar of capital spending will create future profit. That is why this moment requires balance. You cannot be so bearish that you refuse to participate in long-term opportunities. You also cannot be so euphoric that you forget the risks that remain. The second principle is this: you should not confuse a bounce from fear with a full resolution of the cycle. The US and Iran situation still matters because war risk moves through the economy through oil. Oil is one of the fastest transmission mechanisms from geopolitical conflict into inflation, corporate margins, consumer spending, and Federal Reserve policy. If oil stays high, inflation becomes harder to control. If inflation becomes harder to control, the Fed has less room to cut rates. If the Fed has less room to cut rates, risk assets lose one of their strongest sources of support. If consumers pay more for energy, they have less money for everything else. If businesses pay more for transportation and inputs, margins can be pressured. So when people say the war risk is fading, the next question should be, what is happening to oil? Oil is the bridge between geopolitics and your portfolio. That is why the Strait of Hormuz matters. It is not only a military or diplomatic issue, it is an inflation issue, it is a liquidity issue, it is a market issue. Now the market wants oil to cool. If oil returns toward pre-conflict levels, inflation pressure may ease. The Fed may have more room to soften. Corporate margins may look better. Consumer confidence may improve. Risk assets may continue grinding higher, but if oil remains elevated or spikes again, the market can quickly reprice. That is the third principle in a fragile macro environment. One commodity can change the whole policy path. People often look at stocks and crypto as if they exist in their own world. They do not. They exist inside a system of energy prices, inflation, rates, liquidity, earnings, and psychology. That system is what matters. Now let us talk about why markets are moving higher even though the macro picture is not fully clean. The simple explanation is greed, but greed itself is not enough. Greed needs a story. Right now, the story has several parts. First, the worst case war scenario has not played out. Markets had been pricing some possibility of broader conflict, oil disruption, and severe instability. When that risk appears to decline, even temporarily, assets can rally. Second, earnings have been stronger than many expected. Corporate profits are still the bloodstream of the stock market. If large companies continue to make money and raise expectations, investors have a reason to buy. Third, AI remains the dominant growth narrative. The market still believes AI infrastructure, models, chips, software, cloud computing, robotics, and automation will define the next decade. As long as that belief remains intact, dips in major technology names can be bought aggressively. Fourth, Bitcoin and risk assets benefit when investors believe the future will be easier, more liquid, or more adoption driven. If people believe Bitcoin will be higher 12 months from now, and if institutions continue moving into the space, short-term fear can become an opportunity for long-term believers. Fifth, positioning matters. If many investors were underexposed after a sell-off, a rally can force them to buy back in. This can create a feedback loop where rising prices create more buying, not because the world is perfect, but because people cannot tolerate being left behind. That is how sharp recoveries happen. But this rally is still not proof that all risks are gone. It is proof that markets are willing to buy uncertainty when the expected future looks better than the feared future. Now, the retail investor data matters because it tells us how people are thinking. Many retail investors believe global stock markets will be higher in 12 months. Many believe Bitcoin will be higher. Many plan to invest significant money over the next year. Many also want to increase cash reserves. This combination is interesting. People want upside, but they also want protection. They want to participate, but they are afraid of another dip. The tension is exactly why dollar cost averaging makes sense for many investors. If you wait entirely on the sidelines for a 20% correction, you may miss the upside if the correction never comes. If you go all in at once, you may suffer badly if the correction arrives. Dollar cost averaging is the middle path. You buy consistently while keeping some cash available in case the market gives you a better price. This is not the most exciting strategy, but good strategy is not always exciting. It is designed to work across uncertainty. That is the fourth principle. When the future is unclear, but the long-term direction is favorable, average in and keep reserves. A person in the wealth accumulation phase should be careful about doing nothing. Waiting for the perfect crash can become an excuse for permanent inaction. Markets spend much more time rising than falling over long periods. The S&P 500 has historically finished positive in roughly 7 out of 10 years. Bull market conditions occupy far more time than bear market conditions. That does not mean crashes do not happen. They do. It means that if your strategy requires you to wait for the perfect crash before participating, you may spend too much time out of the game. And being out of the game during a major technological advancement can be expensive. This is especially true now because the AI cycle may be one of the largest productivity and capital allocation shifts of our generation. People can argue whether AI is a bubble. They can argue whether some valuations are excessive. They can argue whether certain companies will earn enough to justify the spending. Those are valid debates. But the direction of the world is clear enough to take seriously. AI, robotics, automation, and digital infrastructure are going to reshape the economy. The exact timing is uncertain, the scale is uncertain. The winners are uncertain, but the direction is real. That is why doing nothing can be risky. Risk is not only losing money in a drawdown, risk is also missing a structural transformation because you waited for emotional comfort. Now, the discussion about universal basic income or universal basic wealth is not a small side note. When people like Elon Musk and Sam Altman talk about government checks or basic wealth as a response to AI-driven unemployment, they are revealing how seriously some of the most important technology leaders take the labor disruption risk. Whether these policies happen in 5 years, 15 years, or much later is uncertain. But the fact that these conversations are happening tells us that the people building the technology expect the labor market to change. If a significant part of the economy becomes automated, there will be two broad groups of people. One group will own assets, technology, equity, Bitcoin, businesses, productive capital, and scarce resources connected to the new economy. The other group will mainly consume the output of systems they do not own and depend on wages, benefits, or government transfers. That is a very different future. The difference between those two groups may determine the next major wealth divide. This is the fifth principle. When technology changes labor, ownership becomes more important. If AI increases productivity, but you own none of the assets that benefit, you may only experience job risk, wage pressure, and dependence. If AI increases productivity and you own part of the companies, platforms, infrastructure, or monetary assets that benefit from the shift, you have a chance to participate. This is why investing is not just about making money. It is about choosing which side of the economic transformation you stand on. You can be only a consumer in someone else's economy, or you can become an owner of assets inside the economy being built. The choice will not be perfect. You will not own every winner. You will make mistakes. Some investments will disappoint, but the broad principle is powerful. Own assets before the system changes. Do not wait until the change is obvious to everyone. Now, this does not mean you should blindly chase every AI stock or every crypto token. That would be reckless. It means that you need a disciplined process for identifying where the money, attention, liquidity, and real adoption are moving. The source discusses information overload. This is a very real problem in the past. Retail investors had less information than Wall Street. Today, the problem has partly reversed. Many ordinary investors have too much information. Social media, financial news, AI tools, newsletters, charts on, chain data, podcasts, YouTube videos, influencer portfolios, and constant alerts create a fire hose of signals. But more information does not automatically create better decisions. Often, it creates paralysis. People see too many possible trades and do nothing. Or they see too many conflicting opinions and jump from one idea to another. Or they confuse quantity of information with quality of understanding. A serious investor must reduce the field, focus on what actually moves the needle right now. There are 5 major variables to watch: war risk in Iran and the Middle East, oil prices, inflation and rate, cut expectations, corporate earnings, AI optimism. These 5 are the main levers in the current market system. Everything else should be evaluated by whether it changes one of those levers. That is the 6th principle. Do not react to every headline. Ask whether the headline changes the real variables. If a headline does not change the war risk, oil path, inflation path, Fed path, earnings path, or AI thesis, it may not deserve much reaction. This is how you avoid getting pulled around by every notification. Now let us examine the first variable, the war in Iran. The worst case scenario would be a broader ground conflict, a major escalation, direct attacks on shipping, serious disruption in the Strait of Hormuz, and a deepening regional war that would likely push oil higher, increase inflation, reduce risk appetite, and pressure markets. The more likely path described in the source is a messy middle. Not full resolution, not full war, a continuing ceasefire or partial truce, periodic flare-ups, isolated incidents, ongoing negotiations, sanctions disputes, and continued tension around uranium enrichment, missile capabilities, oil tanker access, and military presence. The messy middle is not peace, but markets can rally in the messy middle if the worst-case scenario is avoided. This is why investors must watch whether the situation changes the oil flow and inflation path, not only whether the headlines sound frightening. The second variable is oil. Oil transmits war into the economy faster than almost anything else. If oil stays high, inflation stays sticky. If inflation stays sticky, rate cuts become harder. If rate cuts become harder, risk assets may lose momentum. If oil cools, the market has more room to breathe. So oil is not just an energy trade, it is a macro signal. The third variable is inflation and interest rates. Risk assets love the possibility of lower rates because lower rates increase liquidity, reduce borrowing costs, support valuations, and encourage investors to move out on the risk curve. If the market believes cuts are coming, it may rally before the cuts arrive. But if inflation rises because oil remains high, the Fed cannot easily ease. A new Fed chair or a more dovish leadership change may affect expectations, but no chair can ignore inflation completely without risking credibility. This is why the market can get excited about future cuts while still being vulnerable to any inflation surprise. The fourth variable is corporate earnings. Strong earnings are one of the main reasons the market has been resilient. If companies continue to beat expectations and forward earnings estimates rise, the stock market can grind higher even with macro uncertainty. Earnings are the foundation. But if earnings weaken, the story changes quickly. A market trading on AI optimism and future growth can tolerate a lot, but not collapsing profits forever. The fifth variable is AI optimism. Markets currently trade on whether investors believe the AI trade remains intact. If AI announcements, model improvements, cloud spending, infrastructure capex, and chip demand continue to support the narrative, dips in major tech may be bought. If investors believe AI spending is excessive or threatened by cheaper models, the market can correct sharply. We saw how a single AI-related shock can move major stocks dramatically. So AI optimism is not just a technology story, it is an index-level market driver. Now, when these 5 variables align positively, markets can move strongly higher. War risk contained, oil cooling, inflation contained, rate cut probability rising. Earnings strong, AI optimism intact. That is the bullish path. When they align negatively, markets can correct quickly. War risk rising, oil spiking, inflation re-accelerating, rate cuts delayed, earnings questioned, AI optimism cracked. That is the bearish path most of the time. They will not all align. That is why markets feel choppy. Now, what is the right move if you believe the long-term direction is higher but short-term correction? Risk remains. The answer is not to guess perfectly. The answer is to structure the portfolio so that you participate if markets rise and have firepower if markets fall. This is why dollar cost averaging with cash reserves is rational. You keep buying because the long-term trend may continue. You keep reserves because a better entry may appear. You do not need to predict which happens first. This is the seventh principle: participate, but do not exhaust your flexibility. Now, let us talk about asymmetric upside. An asymmetric opportunity is not simply something that can go up a lot. Many things can go up a lot. The key is that the potential upside is much larger than the downside relative to the probability and the position size. It usually requires several factors to come together: a strong narrative before the crowd fully understands it, a liquidity path, a catalyst, relative strength during uncertainty, a market that has not fully priced the opportunity, a clear invalidation point, a favorable risk. Reward ratio: this is the framework. The source uses the example of a prior crypto trade where a developing narrative around Coinbase S-based network and a decentralized exchange created a high upside opportunity. The important lesson is not to copy that exact trade. The important lesson is the pattern. Find a major platform or ecosystem before full attention arrives. Find the asset that benefits directly from the liquidity and activity moving into that ecosystem. Look for price levels where the downside is defined relative to the upside. Build conviction through research. Then size the position according to risk. That is the process. But this process is not for everyone. High upside crypto trades can be extremely volatile. They can fall sharply, they can fail. Liquidity can disappear, narratives can shift, tokens can underperform even if the ecosystem grows. Regulation can intervene, technical risks can appear. Selling is often harder than buying. So the eighth principle is this: asymmetric upside is valuable only if you have asymmetric discipline. Most people want the upside. They do not want the work, volatility, or exit discipline. That is why they lose money. Now, the source makes an important distinction between trading in the right conditions and trading all the time. This is one of the most important lessons for anyone interested in higher risk markets. The biggest money often comes from the right conditions, not constant activity. There are periods when the market trend is strong, liquidity is returning, narratives are clear, and risk assets move quickly. In those environments, aggressive trades can work. There are also periods when markets are choppy, liquidity is thin, narratives are fragmented, and every move reverses. In those environments, constant trading destroys people. The skill is knowing which environment you are in right now. The source characterizes the market as choppy but improving. That means watch lists matter, research matters, preparation matters, but reckless chasing may not be ideal. This is similar to fishing. There are moments when the tide is right, conditions are aligned, and the fish are feeding. You can cast almost anywhere and get action. There are other times when the water is pressured, the bite is weak, and forcing trades produces frustration. Markets are the same. You do not need to trade aggressively every day. You need to know when the conditions justify turning the engine on. That is the ninth principle. Your activity level should match market conditions. Now, how do you identify the opportunities that may move when conditions improve? Look for assets that did well before the sell-off. Look for assets that refuse to die during uncertainty. Look for relative strength. Look for real usage, fees, revenue volume, or adoption. Look for catalysts that the market has not fully priced. Look for narratives that can attract attention quickly when liquidity returns. Look for assets with clear communities and structural demand. Look for assets where the downside is understandable and the upside is large. Then build a watch list. Do not simply buy everything green. Green is not enough. A strong asset rising in a weak market is interesting. A random asset rising because of a temporary pump is dangerous. This is why research matters. Now, let us talk about Bitcoin. Bitcoin remains the core crypto asset. It is the asset most institutions understand. First, it has the deepest liquidity, strongest narrative, and largest market structure. If Bitcoin is above important support levels and institutional demand remains strong, the crypto thesis remains intact. The source describes zones above $70,000. The thesis remains constructive. $60,000 to $70,000 may be attractive buying zones. Around $50,000 would be viewed as a major opportunity by someone with strong conviction and experience. Above $80,000 to $82,000 could confirm a breakout. The exact levels will change over time, but the principle is useful. Define levels before emotions arrive. When the price hits the level, you do not improvise. You execute the plan if the thesis remains intact. You know what invalidates the trade. You know how much you can lose. You know the size. This is how mechanical systems reduce panic, but leverage is dangerous. The source mentions leveraging up personally in certain extreme levels while not recommending it to inexperienced people. That warning matters. Leverage can turn a good thesis into a liquidation. It can destroy you before the asset moves in your favor. The 10th principle is this: a correct thesis with wrong leverage can still ruin you. Bitcoin can be a core allocation. It can also be a volatile asset that should be sized appropriately for someone seeking wealth preservation with upside. Bitcoin may be a smaller part of a diversified system for someone early in wealth accumulation. The temptation to concentrate may be stronger, but so is the risk. Your stage of life matters. A person already financially secure should not take the same risk as someone trying to flip a small bag, and someone trying to flip a small bag should understand they may lose it. Now let us talk about hyperliquid and the hype thesis is presented in the source. The claim is that hyperliquid has become one of the deepest liquidity venues in crypto, generating large annualized fees and earnings with significant TVL and perpetual trading volume. The source emphasizes that a large portion of revenue is routed back into token buybacks, creating a structural value accrual mechanism. That is the first part of the thesis: real usage, real fees, real volume. Value capture. This is very different from a crypto asset that only has a meme and no economic activity. The second part is the expansion beyond crypto into 24/7 trading of commodities, equities, and market exposures on chain. If users can trade oil, gold, silver, SP500 futures, Nasdaq indexes, Tesla, Apple, Nvidia, Amazon, and other assets outside traditional market hours, then the platform is not just a crypto exchange. It is trying to become a broader on-chain financial venue. That is an important narrative. The third part is prediction markets. If Hyperliquid launches native permissionless prediction markets with margin and existing liquidity, it could compete with platforms like Polymarket and Kalshi. Prediction markets have already shown major trading volume and user growth. If Hyperliquid captures a meaningful share, fees could expand. Again, and if revenue routes to buybacks, token economics could benefit. This is the upside case. But there are risks. Validator decentralization is one structural concern. If the network has too few validators, critics may argue that it lacks credible neutrality. Centralization risk matters if the platform is trying to become an important financial layer. Regulatory risk also matters. Perpetuals, prediction markets, token buybacks, and on-chain trading of traditional assets can all attract scrutiny. Technical risk matters. Competition matters. Smart contract risk matters. Liquidity can disappear if confidence breaks, so the thesis may be strong, but it is not risk-free. That is the 11th principle. Real usage improves a crypto thesis, but it does not eliminate crypto risk. If hype or any related asset becomes a high-conviction play, it still requires position sizing, entry discipline, and an exit plan. The source suggests a possible 2 to 4 times upside scenario depending on market conditions. That may be attractive, but a price target is not a plan by itself. You need to know what would make you reduce, hold, add, or exit. You need to know how much of your portfolio belongs in such a risk asset conviction. Without risk, control becomes arrogance. Now, the source also discusses a Nasdaq listed equity tied to hyperliquid treasury exposure. This is presented as a more asymmetric or leveraged way to gain exposure to the hype thesis through a public market vehicle. It holds hype tokens, has remaining deployable capital, an equity line of credit, and a buyback program. It is described as different from other crypto treasury companies because it sits on unrealized gains and because the underlying hyperliquid ecosystem may generate income. This structure matters because it brings crypto exposure into the traditional equity market. But it also introduces a new set of risks: net asset value risk, premium or discount risk, corporate governance risk, dilution risk, liquidity risk, regulatory risk, management execution, market perception. If the stock trades near NAV, the margin of safety may differ from a situation where it trades at a large discount. If it trades at a huge premium, the risk can rise even if the underlying hype thesis is strong. Treasury companies can become speculative wrappers. They can amplify upside and downside. So PER may be an interesting watchlist asset, but it is not the same thing as owning the underlying token. And it is not the same thing as owning a diversified equity fund. That is the 12th principle: wrappers change risk. A crypto treasury equity does not simply equal the crypto asset. It has its own capital structure, management, premium, discount, and market behavior. Now, the source discusses MicroStrategy as a core equity wrapper for Bitcoin. The logic is straightforward. If you are bullish on Bitcoin and want public equity exposure that can move more aggressively than Bitcoin, MicroStrategy has historically acted like leveraged Bitcoin exposure because of its large Bitcoin treasury and capital market strategy. That makes it powerful when Bitcoin rises. It also makes it dangerous when Bitcoin falls. It is not a normal software company in the way investors once understood it. It is a financial vehicle tied to Bitcoin accumulation and market appetite for that strategy. If Bitcoin moves higher, MicroStrategy can outperform. If Bitcoin falls or the premium compresses, it can underperform badly. The source frames it as a strong trade if Bitcoin moves toward much higher institutional price targets. That may be true in a bullish scenario. But again, risk control matters. MicroStrategy is not Bitcoin. It is a leveraged equity expression of Bitcoin exposure that has different risks. The 13th principle is this: leverage can be explicit or embedded. You do not need margin to be leveraged if the asset you buy already behaves like leverage. MicroStrategy can be embedded leverage to Bitcoin. PER may be embedded leverage to hype. Crypto altcoins can be embedded leverage to the broader crypto cycle. Meme coins can be embedded leverage to retail attention. Understand the leverage before sizing. Now, the source discusses Pengu as a meme coin allocation. The thesis is that every crypto bull cycle tends to produce a high-cap meme coin that captures retail attention. Dogecoin, Shiba Inu, and Dogwafat are examples from prior cycles. The argument is that Pengu sits at the intersection of brand, product market fit, Web2 recognition, narrative, and retail onboarding. This is a classic attention trade. Meme coins are not valued like businesses. They are valued by attention, community, liquidity, narrative, exchange access, timing, and reflexivity. When attention arrives, they can move extremely fast. When attention fades, they can collapse. The source is clear that this would not be a whole portfolio allocation, but a watch list or tactical exposure for when market conditions improve. That is the correct framing. Meme coin risk is extreme. It should not be confused with investing in productive assets. The 14th principle is this: attention is an asset in crypto, but it is unstable. You can make money from attention if you are early and disciplined. You can lose money badly if you are late and emotional. Now, the source discusses BMNR, or an Ethereum-related treasury or equity trade associated with Tom Lee and a large media narrative. The core idea is that Ethereum will remain relevant, and a public market vehicle with a recognizable spokesperson, funding, and holdings can become a strong narrative trade when markets return. Again, the pattern is similar: underlying crypto asset, public market wrapper, media narrative. Treasury holdings, premium or discount to NAV risk. On environment, this can work in strong markets because traditional investors may prefer stock market access to crypto exposure. But it also carries wrapper risk, premium risk, dilution risk, and hype cycle risk. The important lesson is not to buy every vehicle. It is to understand how narratives transmit from crypto into equities and back again. Liquidity rotates, attention rotates, capital looks for the easiest vehicle when traditional markets want crypto exposure. Public wrappers can move. But when the cycle turns, these wrappers can fall hard. Now, the source mentions Solana and Ethereum as still relevant in the next bull run. This fits the broader idea that large cap crypto assets may continue to matter. Bitcoin is the core store of value or institutional crypto asset. Ethereum and Solana represent smart contract ecosystems. Hype represents a high conviction specific infrastructure play. Pengu represents meme, fake consumer attention. PER and MicroStrategy represent equity wrappers. This is a portfolio of narratives approach: core exposure, ecosystem exposure, high conviction alt exposure, meme attention exposure, equity wrapper leverage. This can produce high upside in a crypto bull cycle. It can also create severe downside in a drawdown. So diversification matters even within crypto. But diversification inside crypto is not the same as portfolio diversification. If the entire crypto market falls, many assets can fall together. The 15th principle is this: crypto diversification reduces single token risk, but it does not remove cycle risk. To manage total risk, crypto must be placed inside a broader portfolio with cash, equities, perhaps gold or other assets, and personal financial resilience. Now let us talk about selling. The source says selling is hard, maybe harder than buying early. That is true. Buying early requires conviction. Selling requires discipline against greed. When a position rises 10 times or 20 times, the mind starts imagining even larger numbers. Every sale feels like a mistake. If the price keeps rising, every hold feels genius until the reversal begins. This is why exit plans matter. If you are in a high upside crypto trade, you need a framework before the mania arrives. Take profits at predetermined levels, reduce risk when the position becomes too large. Use trailing stops if that fits the strategy, rotate some gains into core assets. Do not let one trade become your entire identity. Understand the tax impact. Do not assume you will sell rationally at the top. Most people do not. That is the 16th principle. You do not own a gain until you protect it. Paper wealth can disappear quickly in crypto. Now, the source repeatedly emphasizes conviction. Conviction is important because volatility will test you. But conviction must come from research, not hope. You cannot build real conviction from someone else's excitement. You build it by understanding the thesis, risks, catalysts, levels, and invalidation. Borrowed conviction breaks under pressure. Real conviction can still be wrong, but at least it is grounded. That is why doing your own research is not a cliché, it is survival. But research does not mean consuming endless opinions. It means identifying the few variables that matter and studying them deeply. For Bitcoin chain flows, institutional demand, ETF inflows, key levels, macro liquidity, and adoption matter. For hype, fees, volume, TVL buybacks, validator, decentralization, upgrades, and market share matter. For PER, NAV, hype holdings, management, capital structure, premium or discount, and liquidity matter. For MicroStrategy, Bitcoin holdings, debt, equity issuance, premium, and Bitcoin price matter. For Pengu, attention. Brand strength, liquidity, exchange access, and retail momentum matter. For Ethereum or Solana. Related vehicles, ecosystem activity, fee revenue, developer traction, action, capital flows, and narrative strength matter. Each thesis has a dashboard. Without a dashboard, you are only reacting. Now, let us think about the role of the crowd. The source suggests that retail often pays attention at the worst time. When markets are boring or choppy, retail is tuned out. When markets become euphoric and expensive, retail comes back. That pattern has repeated many times. The opportunity often appears before the crowd returns. When views are low, attention is low. When attention is low but the setup is improving, that can be useful. But do not rely only on crowd behavior. It is one factor, not the whole system. The correct approach is confluence, market structure, narrative, relative strength, liquidity, catalyst, crowd apathy, valuation, or price position. When several factors align, conviction can rise. This is the 17th principle. One signal is not enough. Look for confluence. Now, the source mentions that market money does not flow into everything at once. In risk, on phases, liquidity rotates. One asset explodes, then another, then another. This is especially true in crypto. The first leaders move, then profits rotate into second-order plays, then memes may move, then lower. Quality assets may rally near the end. Understanding rotation can help, but it is difficult. If you are too early in a low liquidity asset, you may wait. If you are too late, you may become exit liquidity. If you rotate too much, you may miss the main move. If you never rotate, you may hold through the round trip. This is why a plan matters. Core holdings for the full cycle, tactical holdings for rotations. Clear profit, taking rules, cash reserves for dips. No overtrading and chop. This is the structure. Now let us connect this back to the broader equity market. The long-term thesis is that markets will be higher over 25 and 10 years because productivity, AI, corporate earnings, monetary systems, and asset ownership continue to drive nominal growth. This does not mean there will be no corrections, there will be corrections. It means that if you are in the wealth accumulation phase, completely sitting out may be more dangerous than participating with discipline. This is a very important distinction. The best move for most people may not be to make a massive concentrated crypto bet. For many, the best move is to dollar cost average into broad markets while selectively adding asymmetric opportunities with money they can afford to risk. This keeps the foundation strong. The source is aggressive because it is speaking to opportunity. But a Ray Dalio style system must include balance. You should have core assets, you should have liquidity, you should have asymmetric bets only at a size that will not destroy you. That is the 18th principle. The foundation funds the future. The asymmetric bet accelerates it only if sized correctly. Now, let us think about AI and wealth transfer. The source frames this moment as a potential generational wealth opportunity because AI, robotics, crypto, and markets may create a transfer from unprepared people to prepared owners of assets. That may sound dramatic, but the mechanism is clear. When a new technology changes productivity, capital flows toward the owners of the technology, infrastructure, and networks. Workers whose skills are displaced may suffer. Consumers may benefit from cheaper services, but the owners capture much of the economic value. Government may respond with transfers. Asset prices may reflect future growth. Those who own assets participate. Those who do not may depend on wages or benefits. This is why preparation matters. You cannot control the full future of AI. You can control whether you build assets, skills, liquidity, and knowledge. That is the practical move. Now, I would be careful not to turn this into panic. Not every job disappears. Not every AI forecast comes true quickly. Human labor adapts, new industries emerge, policy responds, people retrain. The future is not one straight line. But ignoring the trend is also dangerous. When the most important technology leaders openly discuss labor displacement and government transfers, you should pay attention. Not with fear, with preparation. The 19th principle is this. When the system tells you a structural change is coming, do not waste energy denying it. Build resilience. Resilience means assets. Resilience means skills. Resilience means low debt. Resilience means flexible thinking. Resilience means not depending entirely on one income source. Now, let us return to the immediate market. The market can rally because the worst case scenario did not happen. It can keep rallying if oil cools. Earnings stay strong, inflation remains contained, and AI optimism holds. It can pull back if oil stays high. Inflation reaccelerates, the Fed cannot ease, or war risk returns. So the right posture is not certainty. The right posture is scenario-based. If markets rise, your DCA and existing positions participate. If markets fall, your cash reserves and watch list allow you to buy. If markets chop, you avoid overtrading and continue research. If the trend becomes clear, you size more aggressively according to your rules. This is a robust system. Now, what does robust mean? It means the system does not depend on one forecast. If your plan only works if Bitcoin goes straight up, it is fragile. If your plan only works if the SP 500 falls 20% before rising, it is fragile. If your plan only works if the Fed cuts soon, it is fragile. If your plan only works if oil collapses, it is fragile. A robust plan can handle multiple paths. That is what most investors need. Now let us discuss position sizing. The more speculative the asset, the smaller it should usually be relative to total net worth unless you consciously accept high loss risk. Bitcoin may be larger than altcoins. Altcoins may be larger than meme coins. Equity wrappers may be sized according to volatility. Broad index funds may be the core. Cash reserves should be large enough to survive emergencies and act on opportunity. This hierarchy matters. Do not treat a meme coin like the SP 500. Do not treat a crypto treasury company like a savings account. Do not treat a leveraged futures trade like a long-term investment. Every asset has a different job and risk profile. The 20th principle is this: match position size to uncertainty. The less certain the outcome and the higher the volatility, the more disciplined the size must be. Now, the source also includes personal testimony about rising from financial struggle through learning online and taking advantage of opportunities. That part matters because it explains the emotional force behind the message. The idea is that access to information can change a life, but access alone is not enough. Many people watch the same videos and do nothing. Many people have the same information and still lose money because they lack process. Many people see opportunities and cannot act because they have no cash, no conviction, or too much fear. Information must become action. Information is entertainment. This is the 21st principle. Free information can be life-changing only if it becomes disciplined behavior. Now let us think about the spiritual or grounding point near the end of the source. The speaker says that staying grounded in faith helps make better decisions in stressful seasons. In a Ray Dalio style framework, the broader principle is that every investor needs something that grounds them because markets trigger fear, greed, stress, and identity. You need a center. For some people, that is faith. For others, family. For others, principles. For others, a written process. Whatever it is, you need something deeper than price movement. If your emotional state rises and falls with every candle on a chart, you will not make good decisions. Markets reward clarity. Stress destroys clarity. Grounding restores clarity. That is the 22nd principle. Your emotional system is part of your investment system. If you cannot stay calm, you cannot execute. Now let us put the entire current setup into one chain. War risk eased enough to reduce immediate fear. Oil risk remains. Inflation risk remains. Rate cut expectations depend on inflation. Earnings are supporting stocks. AI optimism is supporting the major indices. Bitcoin is recovering with risk appetite. Retail investors still expect higher markets markets over 12 months. Many people want to invest but also want cash. The best general structure is DCA plus reserves. The best speculative structure is watch lists, relative strength, narrative, liquidity, and catalysts. The biggest long-term transformation is AI and automation. The biggest wealth divide may be between owners and non-owners. That is the system. Now, let us think about what not to do. Do not chase every green candle. Do not assume the ceasefire equals permanent peace. Do not ignore oil. Do not assume rate cuts are guaranteed. Do not sit entirely in cash, waiting for a perfect crash. Do not use leverage if you do not understand liquidation risk. Do not copy someone else's high conviction trade without doing your own research. Do not buy meme coins with money you need. Do not confuse a public equity wrapper with the underlying crypto asset. Do not forget that selling is harder than buying. Do not let information overload turn into paralysis. Do not become the crowd that arrives only after everyone else is already rich. Now, what should you do? Identify the 5 market variables. DCA into the assets that fit your long-term plan. Keep extra cash for dips. Build a watch list of asymmetric opportunities. Study the strongest narratives before retail attention returns. Look for relative strength during fear. Understand the real adoption and revenue behind any crypto thesis. Define levels in validation and profit-taking rules. Size risk correctly. Stay grounded. Act only when your process says to act. This is how you turn uncertainty into opportunity. Now, let us discuss the difference between investing and trading. Investing is ownership based on long-term value creation. It can include broad equities, Bitcoin for some, quality companies, and assets tied to structural trends. Trading is taking advantage of price movement, momentum, narratives, and liquidity windows. Both can be legitimate, but they require different rules. If you mix them, you get confused. You buy a trade, it falls, and you call it an investment. You buy an investment, it rises, and you treat it like a trade you enter without an exit plan. You hold without understanding. You sell because of emotion. You buy because of FOMO. The correct approach is to label positions. Core investment, satellite investment, speculative trade, cash reserve. Each has rules. This is the 23rd principle. Do not let every position become the same in your mind. Now, if Bitcoin is a core crypto allocation, it may be held through cycles with a clear percentage of the portfolio. If hype is a high conviction alt, it may have a different risk and profit-taking plan. If PER is an equity wrapper, it must be evaluated relative to NAV and market structure. If MicroStrategy is a leveraged Bitcoin equity, it must be sized for volatility. If Pengu is a meme allocation, it must be treated as high-risk attention exposure. If BMNR is a narrative equity tied to Ethereum, it must be treated as a speculative cycle play. Different assets, different rules. Now, one of the most dangerous things in crypto is that success can make people reckless. If a prior trade turns $120,000 into millions, the mind may begin to believe that large concentrated bets are easy. They are not. For every spectacular success, there are many people who lost everything using the same concentration without the same timing, conviction, or exit. A good investor learns from success without becoming arrogant. The process matters more than the outcome. Was the thesis real? Was the risk understood? Was the entry rational? Was the sizing appropriate? Was the exit disciplined? If yes, the process is worth studying. If the outcome was mostly luck, do not repeat it blindly. This is the 24th principle. Good outcomes do not always mean good process, and bad outcomes do not always mean bad process. Evaluate the process. Now let us talk about the broader idea of generational wealth. Generational wealth is not created only by one trade. It is preserved by systems. Many people make money in a bull market and lose it in the next bear market. That is not generational wealth. That is a round-trip generational wealth. Requires acquisition and preservation. You take risk when the opportunity is favorable. You reduce risk when the reward has been captured. You convert some speculative gains into durable assets. You pay taxes responsibly. You protect liquidity. You avoid lifestyle explosion. You build a base that survives. This is the part many traders ignore. Getting rich is one problem. Staying rich is another. The source touches on this by saying the speaker is moving from full wealth accumulation toward wealth preservation with upside. That is a very important stage change. The strategy that may make sense when you have little capital may not make sense when you have millions. The risk profile should evolve. This is the 25th principle. Your strategy must change as your balance sheet changes. If you have nothing, you may be willing to take high risk with a small amount. If you have built wealth, protecting the base becomes more important. If you have family responsibilities, risk changes again. If your goal is financial freedom, you cannot keep playing as if you have nothing to lose. Now, let us think about the possibility that markets go down again. The source believes another pullback may happen. That is possible. Oil could remain high. Inflation could rise. The Fed could stay tight. War risk could return. Earnings could disappoint. AI optimism could cool. Bitcoin could fail to break out. Liquidity could remain choppy. If that happens, the plan is not to panic. The plan is to use reserves and levels, buy more of long-term assets if the thesis is intact. Add to high conviction watchlist names only if the risk reward improves. Avoid overtrading in the middle of chop. Do not assume every dip is automatically a gift. Some dips are warnings. Evaluate whether the 5 variables changed. This is the 26th principle. A dip is an opportunity only when the long-term thesis remains intact. Now, what if markets go straight higher? Then your DCA and current positions participate. Your cash reserves will feel like a drag, but they were insurance. Do not regret insurance, simply because the bad event did not happen. If the market keeps rising and your thesis strengthens, you can continue averaging in. You do not need to chase with everything. This is the 27th principle. Cash has opportunity cost, but it also has optionality. You want enough cash to act, but not so much that you are permanently sidelined. Now, let us think about the AI labor future again. If universal income or universal wealth becomes a serious policy discussion, the asset market implications could be enormous. Government transfers would support consumption. AI productivity could raise corporate profits. Monetary policy and fiscal policy could become more intertwined. Inflation risk could rise if transfers exceed productive capacity. Asset owners could benefit if nominal spending rises. Workers could face disruption. Taxes could change. This is not a small shift, but it is uncertain. So the right approach is not to bet everything on one political outcome. The right approach is to prepare for a world where labor is less secure and asset ownership is more important. That is robust. Now, the source says many people are asleep at the wheel. I would say it differently. Many people are overwhelmed, distracted, and exhausted. They see the change, but they do not know what to do. The remedy is not shame. It is structure. Here is the structure. Own broad productive assets. Hold some Bitcoin or other scarce digital asset exposure if it fits your risk tolerance. Study asymmetric opportunities, but do not overexpose. Build skills connected to the future economy. Keep cash reserves. Avoid high interest debt. Reduce unnecessary fixed expenses. Use AI tools to improve your own productivity. Do not depend entirely on one employer. Think like an owner. That is preparation. Now let us talk about AI tools and investor research. AI can summarize filings, compare businesses, explain concepts, and speed up learning. This reduces the information gap between retail and institutions. But AI can also hallucinate, overstate, or produce surface-level confidence. You still need judgment. AI can help research. It cannot replace responsibility. You must verify. You must understand. You must decide. The 28th principle is this: tools increase capacity, but judgment determines outcome. Now let us bring this into a clear plan for the current market. First, identify your core allocation: broad stocks, long-term assets, Bitcoin if appropriate, cash, and any other diversified holdings. Second, keep buying regularly, weekly or monthly according to your cash flow. Third, keep dry powder. Do not exhaust cash if you believe another correction is possible. Fourth, monitor the 5 variables: Iran, oil, inflation, Fed rates, earnings, AI. Fifth, build a watch list of asymmetric plays, Bitcoin levels, hype, per MicroStrategy, Pengu, BMNR, Ethereum, Solana, or other assets you personally understand. Sixth, do deep research before committing. Do not buy because of a name. Seventh, define entries, exits, and invalidation. Eighth, size risk so failure does not destroy you. Ninth, take profits when asymmetric trades work. 10th, convert some gains into durable wealth. This is a complete cycle system. Now, let us think about the source phrase, last chance at generational wealth. That is powerful and emotionally charged. I would be careful with it. There are always opportunities in markets. This may not be the last chance in a literal sense, but it may be one of the most important windows of this generation because AI, crypto, monetary change, and geopolitical instability are converging. The opportunity is real. The urgency should produce preparation, not panic. That is the key. Panic makes you chase. Preparation makes you ready. Now, what is the difference? Panic says, I must buy something now or I will miss everything. Preparation says, I will build my core, my cash, my watch list, my levels, my research, and my rules. Panic says, I will copy another person's trade. Preparation says, I will understand the thesis and size it according to my life. Panic says, I need to get rich fast. Preparation says, I need to survive long enough to capture the opportunity. This is the distinction that protects you. Now, let us think about liquidity. In both stocks and crypto, liquidity drives cycles. When liquidity expands, risk assets can rise aggressively. When liquidity contracts, even good assets can fall. Crypto is especially liquidity sensitive because many assets depend on speculative capital. If retail attention and liquidity are absent, narratives may not move. When liquidity returns, the strongest narratives move first. That is why timing matters more in crypto than in broad index investing. You can DCA into the SP 500 for decades. You should be more tactical with many altcoins and meme coins. Bitcoin sits somewhere in between for many investors. It has long-term institutional adoption potential, but still moves with liquidity cycles. Again, each asset has a different job. Now, the source mentions that the next cycle may be harder than 2021 because liquidity is lower and retail investors are smarter. This is important. You should not assume the same playbook repeats exactly. The market evolves. More people understand narratives. More people use on-chain tools. More people rotate faster. The window of easy gains may be shorter. Selling may need to happen earlier or more systematically. The past rhymes. It does not repeat. That is the 29th principle. Use old cycles as maps, not scripts. Now let us talk about relative strength. When an asset refuses to fully die during fear, that can be a clue. It means buyers are stepping in. It means the market is supporting it. It means demand exists even when risk appetite is weak. This does not guarantee future upside, but it helps identify what may lead when conditions improve. Relative strength is not magic. It is evidence of demand. If hype holds better than other altcoins during uncertainty, that matters. If Bitcoin reclaims key levels, that matters. If certain equity wrappers stop falling while others are weak, that matters. If AI leaders recover faster than the index, that matters. Price is information, but price must be combined with fundamentals and narrative. Relative strength alone can become chasing. Fundamentals alone can be dead money. Narrative alone can be hype together. They become a stronger framework. This is the 30th principle. Look for alignment between price, fundamentals, narrative, and liquidity. Now, let us consider the major risk in the whole source: overconfidence. The message is high energy and opportunity driven. That can motivate action, but it can also encourage reckless behavior if interpreted badly. A disciplined version of the message is this: there are major opportunities forming across AI equities, Bitcoin, and crypto. The market may pull back again, but long-term direction may remain higher. DCA is better than doing nothing. Cash reserves are better than being all in without flexibility. Asymmetric opportunities should be researched and sized carefully. Crypto can create enormous gains, but also severe losses. Conviction must be earned. Selling must be planned. Grounding matters. This is the balanced version. Now, let us talk about risk of being on the sidelines. If you hold 100% cash waiting for a perfect crash, and markets rise 50% over the next 2 years, your cash protected you from volatility but cost you opportunity. If inflation continues, cash may lose purchasing power. If AI and crypto cycles accelerate, the opportunity cost can be huge. But if you hold zero cash and a correction comes, you may have no ability to buy. Worse, if you need money, you may be forced to sell. This is why extremes are usually wrong. All cash is fragile against upside and inflation. All risk is fragile against drawdowns and life events. The middle system is robust. Now let us think about the 5 variables as a dashboard. War dashboard: is escalation rising or falling? Is the Strait of Hormuz open? Are attacks increasing? Are negotiations continuing? Are US forces being pulled deeper? Oil dashboard: is crude returning to pre-war levels? Are shipping risks falling? Are energy prices feeding into inflation expectations? Inflation and Fed dashboard: are rate cut probabilities rising or falling? Is inflation contained? Is the Fed becoming more dovish or constrained? Earnings dashboard: are SP 500 earnings estimates rising? Are companies guiding higher? Are margins holding? AI dashboard: are major companies still increasing capex? Are models improving? Are chips, cloud, infrastructure, and productivity narratives intact? This dashboard helps reduce noise. If a headline does not affect the dashboard, do not overreact. Now, let us talk about building a watch list. A watch list is not a shopping list to buy everything. It is a research list. The purpose is to prepare before the market gives you entries. When volatility hits, you do not want to start researching from scratch. You want to already know what you like, where you like it, and how much you are willing to risk. This is especially important for crypto because moves happen quickly. If you wait until the breakout to begin learning, you may buy late. Preparation happens in boredom. Profit often happens in chaos. That is the 31st principle. Do the research when attention is low. Now, what should be included in the watch list? Only things you can explain. If you cannot explain why hype has value, do not buy it. If you cannot explain per S relationship to hype and NAV, do not buy it. If you cannot explain MicroStrategy S leverage to Bitcoin, do not buy it. If you cannot explain Pengu S meme and brand thesis, do not buy it. If you cannot explain BMNR S Ethereum related structure, do not buy it. If you cannot explain Bitcoin S thesis, do not buy it. If you can explain them, then move to risk sizing and levels. Understanding first, buying second. Now let us discuss the role of community and newsletters. Communities can help filter information, share research, and identify narratives. But communities can also create groupthink, hype, and pressure to buy. Use community as input, not authority. The market does not care what a community believes. It cares about liquidity, adoption, execution, and price. A strong community can support a narrative. It cannot override reality forever. Now let us talk about using profits. If an asymmetric trade works, what happens next? This is where many people fail. They leave everything in high-risk assets because they want more. Then the cycle turns and the gains disappear. A disciplined plan converts some upside into durable wealth. Pay down debt, build cash reserves, buy broad equities, buy real assets, diversify, reduce risk, set aside taxes, improve life without exploding fixed expenses. This is how a speculative win becomes actual wealth. Otherwise, it is just a number on a screen. The 30-second principle is this. The point of speculation is to convert temporary opportunity into durable freedom. Now let us think about long-term market direction. The source believes that over 25 and 10 years, markets will be higher. That is a reasonable long-term bias for productive assets, especially in nominal terms. Because economies grow, currencies debase, companies adapt, and innovation continues. But the path will not be straight. There may be a 20% correction, there may be a recession, there may be another inflation shock, there may be a crypto crash, there may be regulatory surprises, there may be war headlines, there may be AI disappointment. If you believe the long-term direction is higher, you must still be prepared for short-term pain. Long-term bullish does not mean short-term reckless. Now, let us talk about the broader moral of wealth accumulation. Money does not solve every problem. It does not create spiritual peace. It does not guarantee fulfillment, but financial security changes the options available to a household. It affects schools, neighborhoods, healthcare, safety, stress, time, and the ability to help others. It makes many large problems less destructive. Therefore, pursuing financial strength is not shallow when done with the right values. It is a way to create resilience. But if the pursuit of money becomes identity, greed, or recklessness, it can destroy judgment. This is why grounding matters. The right goal is not just more money. The right goal is more freedom, responsibility, and clarity. Now, let us bring this toward conclusion. This market recovery is real in price, but incomplete in resolution. Stocks and Bitcoin have recovered because investors believe the worst-case geopolitical scenario may be avoided. Earnings remain strong, AI remains powerful, and long-term risk assets may be higher. But oil inflation, Fed policy, and war risks still matter. The best general strategy is not to wait forever and not to go all in. It is to dollar cost average into high-quality long-term assets while keeping cash for a deeper dip. The best speculative strategy is not to buy every green asset. It is to build a watch list of asymmetric opportunities where narrative, liquidity, fundamentals, relative strength, and catalysts align. Bitcoin remains core. High-conviction crypto infrastructure like HYPE may offer upside if the thesis plays out. Equity wrappers like PER and MicroStrategy can amplify exposure but carry wrapper and leverage risk. Meme coins like Pengu can move with attention but are extremely volatile. Ethereum or related vehicles may have their own cycle narratives. All of these require research, sizing, and exit discipline. Now, the bigger story is AI. AI is changing how people think about jobs, productivity, income, government transfers, and ownership. If billionaires and policymakers are already discussing universal income or basic wealth, that tells us they expect real labor disruption. The prepared person does not simply fear this. The prepared person builds ownership in the systems that may benefit. That does not mean blind speculation. It means ownership, skills, and adaptability. Now, I will end with the core principles. First, a rally does not mean the risk is gone. Second, the market can move higher before the world feels safe. Third, do not sit entirely in cash waiting for perfect clarity. Fourth, do not chase without a plan. Fifth, watch the 5 real drivers: war, oil, inflation and rates, earnings, and AI. Sixth, DCA into long-term assets and keep cash reserves. Seventh, study asymmetric opportunities before the crowd returns. Eighth, size speculative positions so you can survive being wrong. Ninth, create exit rules before greed takes over. 10th, convert wins into durable wealth. This is the way to think. Not fear, not euphoria, not prediction addiction. A system. Markets are emotional because people are emotional. They rally on relief. They crash on fear. They overshoot in both directions. But a disciplined investor can use that volatility instead of being controlled by it. The future may bring another dip. It may bring a breakout. It may bring both. You do not need to know the exact sequence to prepare. Build the foundation, keep buying, keep reserves, study the strongest opportunities, stay grounded. When the moment comes, act from principle, not panic. That is how generational opportunities are captured. Not by being the loudest, not by being the most emotional, not by copying someone else without thought, but by being prepared before the crowd realizes preparation was necessary.